So you want to retire early, but all your money is tied up in a retirement account like an IRA or 401k. I'm going to tell you how you can access that money without incurring a penalty through Section 72T. How's it going, guys? My name is John Boyd. I'm a certified financial planner. I'm the founder and lead wealth advisor at Modern Wealth. And we're talking all about Section 72T. This is a really creative strategy that exploits a certain part of the tax code that allows you to take distributions from an account like an IRA or 401k without incurring that 10% penalty. As you may or may not already know, if you attempt to take a distribution from an account like an IRA prior to 59 and a half, you will incur not only ordinary income tax, but a 10% penalty. And this is extremely frustrating because the majority of Americans tend to have most of their savings tied up in the retirement accounts. And more people want to retire far before 59 and a half. So if this is you, if you're someone with a ton of money in a retirement account and you want to retire prior to 59 and a half, or at least pursue part-time work, you don't want to miss today's video. We're going to break down 72T and talk about 3 different scenarios that this could work really, really well in. So Section 72T allows you to make substantially equal periodic payments from your retirement account. And those periodic payments that you make from your retirement account will not incur a 10% penalty. Okay, so let me say that again. As long as you make substantially equal periodic payments from a retirement account, you can take money out of it far before 59 and a half without incurring any penalties. But you can't just take out any amount, right? Let's say you have $500,000 in an IRA and you want to take out $30,000 a year to supplement your living expenses for just a couple years. There are rules that you need to abide by. Well, first and foremost, there are 3 approved methods of calculating those substantially equal periodic payments. There's the RMD method, the fixed amortization method, and the fixed annuity method. Each calculation has its own method of being calculated, and it is relatively complicated, so we are not going to dive into those details today, but you can work with a tax professional to help you calculate it, and there's even tools online to guide you. But to give you a rough idea of how much this could potentially look like, let's say you're 50 years old with a $500,000 IRA and you make substantially equal periodic payments utilizing the RMD method, that would allow you to take roughly $15,000 a year from that IRA without incurring any penalty. Now, keep in mind, the RMD method generates the lowest payout. So if you wanted a higher payout, you would have to utilize one of the other methods. So that's rule number 1. You have to make substantially equal periodic payments utilizing an approved method by the IRS. The second critical rule is that these substantially equal periodic payments must continue for at least 5 years or until you turn 59 and a half, whichever is longer. So if you're someone who is 35 years old who makes this 72T election, you would have well over 20 years of distributions that you would need to make. So as a financial planner, I have utilized Section 72T a handful of times. It can be a really creative way to create liquidity in a financial plan. These are the 3 scenarios that I've utilized them. So number 1, transitioning from full-time work to part-time work. I tend to find that when people find out about Section 72T, they kind of think that, hey, this is a way to create retirement income when I fully retire. And yes, in theory, that could be the case. Generally speaking, when I've seen it work most optimal is when somebody is transitioning from full-time to part-time work. So let's say somebody has worked in tech their whole career and they're burnt out and they want to go do something else. So they go ahead and start their own business, and this business is going to be kind of a easy, chill, part-time job until they fully retire down the road, but they want to go ahead and supplement their living expenses a little bit. Section 72T could potentially help bridge that gap from full-time work to part-time work and then full-time retirement. If we utilize this method, generally we're going to carve out a portion of their IRA to sleeve out into the strategy. So let's say that they have $1 million in pre-tax retirement money. We're not just going to go ahead and do a 72T election on that entire $1 million bucket. If we did that, now we have this distribution that we have to take from their entire retirement portfolio. Instead, what is done is we go ahead and sleeve out maybe a portion, and that portion creates the distribution that they need to bridge that retirement gap. The second scenario that I've utilized this method for is for when somebody is starting a family. So let me explain. So let's say you have a couple and they start to have a family and kids start to come into the picture. And let's say spouse number one wants to quit their job so that they can be home with the kids while they're little. What can be done here is that a 72T election is made from the retirement account to perhaps supplement some of the income during these years. Now, again, keep in mind, it would have to continue all the way until 59 and a half. So by no means am I saying that this is a viable strategy for everyone that is thinking about starting to raise a family, but in certain scenarios, this can work really, really well. Third scenario where this works well is when somebody is looking to retire full time in their 50s. So let's say somebody is 51, 52 years old. They've been working for years. They're burnt out and they just want to retire full time. No part-time work, none of that. They just want to put their feet up, relax, and start living off of their portfolio. This can work really well as a way to bridge the gap between retirement in their 50s and to when they begin to take Social Security in their 60s. Bottom line, Section 72T, when used appropriately, can be a really powerful cash flow tool to keep taxes down when pursuing early retirement. Situations that I've utilized it, I have found that it works well when it's combined with other strategies. So for example, maybe we utilize this strategy and the client is also living off, let's say, dividends and interest from a non-retirement account. And when you combine that money combined with maybe some part-time work money, things are relatively smooth and it can create a really creative cash flow plan for them. If you think taking advantage of Section 72T would work well for your retirement plan, reach out to us, www.modernwealth.com. That's modern spelt with no vowels, wealth.com. We are still taking on new clients and would love to help out you and your family. I hope you learned a thing or two, and we'll see you next time.